Welcome to Sachs Realty's Tuesday night podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our live Tuesday night podcast. We are talking about something completely different tonight, though it does tie to real estate a little bit. We're talking about the stock market, and it's in the news a lot, just like housing. And we have a really special guest tonight that's going to try and help us navigate through the waters of, what's happening in the stock market and where things should be going in 2023. But I do want to caution you guys, this is all based on opinion. I mean, no one really knows. I mean, you've heard me talk about the real estate market and, my opinions on it and where we're going and heading and things like that. But, it's like Monday morning quarterbacking, right? Because until the game plays out, then we can really talk about what happened. But I want to talk about some of this chatter that's in the news. CNBC has recently published an article, literally, hours ago, where they said that this poll of millionaires have said that next year, 2023, in the stock market, they're not so, confident that the stock market's going to do well. And for some, it didn't really do well this year. Especially, we're going to talk about cryptocurrency because, oh man, I know so many people that have been affected by that going down. But look, let's go ahead. Let's bring him in. Josh Rivers. He is actually from Maryland too. And Josh, welcome to our show, man. Tell everybody a little bit about you.
Hey, Todd, thanks for having me. Josh Rivers. I am a financial advisor with Congress Wealth. We're based out of Boston, but I work in the Columbia, Maryland office. I've been a financial advisor for next 2023 will be 23 years. I am a certified financial planner since 2011. I've worked in a couple different aspects of our business. I've been a chief investment officer for a planner group with Lincoln Financial. I've worked with a multifamily office, and I've been with Congress Wealth for the last 6 years as a wealth manager, and live in the Annapolis area and lifelong Marylander.
So, I mean, look, 23 years in this business. I mean, you'd consider yourself an expert.
Yes, as much as anybody is in this business, yeah.
Well, we're going to answer some questions from you guys tonight. So if you have questions for Josh or myself, go ahead and comment them. We'll address it. We'll talk about it because I know, Josh, one of the unique things about our business, the real estate business, as we know, and I've been in it for just over 30 years, from one aspect or another, serving primarily the residential housing market. And it seems that, now Wall Street is entrenched in real estate. More than ever, I guess, and since the crisis, the 2008 downturn, the financial downturn, the Great Recession, they kind of dove in. There's a lot of talk about, billions of dollars on the sideline waiting to gobble up real estate. But when we talk about real estate and the ups and downs of real estate, as I remember it, usually when people were uncertain about their stock portfolio or securities, when they would dive into that, if things weren't going well, they'd pull their money out and then they would go into physical assets like real estate, right? And, it wasn't that long ago, a couple of months ago, I remember reading an article that talked about the stock market not, the confidence in the stock market not really being there. But we all know that since Wall Street's so entrenched in real estate that, they've kind of taken out, and with real estate being in the tank as well, they've kind of taken that option out, well, do you still buy real estate? Do you still buy the physical when, the prices are to what seems to be overpriced? And again, no one knows, but Just kind of tell us, like, what is your feeling, you kind of like your confidence level with the stock market in 2023. And before you say that, I mean, I want to pull this up because um, this article on CNBC, it's titled "Millionaire Investors Haven't Been This Bearish Since 2008." And basically the highlights are saying rich investors are betting on double-digit declines in the stocks next year, according to the CNBC Millionaire Survey, and that 56% of millionaire investors surveyed expected the S&P 500 to decline by 10% in 23. And then really there's a large gap, optimism gap, because the old people, I'll put myself in that category for the purposes of tonight. The older people, we'll say, are the ones that feel a little bit more bearish. And it goes on to say that like 81% of the young or millennial investors in the stock market believe that things are going to be strong. So can you just kind of give us your opinion?
Yeah. So we would tend to agree that 2023 could be challenging, right? We're still battling with inflation. We've got a extremely hawkish Fed that, what was the line in the past? It's about the economy, stupid. Well, it's about inflation, stupid. And not calling you stupid, of course, Todd, but there's, you get what I'm saying. So they're trying to, crush inflation. The Fed cannot control supply, but they can control demand. They're trying to kill demand. You talked about, what 56% of millionaires worrying about next year. Look, investor sentiment is really bad. It's not been this bad since like after 9/11. Okay. So we're in a really bad sentiment place. We're already in a bear market. The S&P is down almost 20%. I think it's a little over 18, after today. And we're definitely in a bear market. Until the Fed pivots and stops raising rates, and we kind of get the news that, we feel like inflation's under control, we're probably not going to see a positive move in the market. Do we think it's going to be like another 2008 and we're going to potentially go down like another 20% from here? We don't think that is going to happen. There's three things that I kind of look at and we look at as a firm. The consumer, although the consumer lately has kind of been racking up a little bit more debt because of inflation, the consumer's in much better shape than they were in 2008. Banks are in much better shape than they were in 2008. Their balance sheets are far cleaner. They're not as leveraged. And the same with most businesses. That was sort of a learning moment for them. Jamie Dimon came out a couple weeks ago. I think everybody believes there's going to be a recession call probably in Q1. And I do realize that by the classic definition, we already had a recession in the first 2 quarters of this year, but there was no call on that. And I think there's going to be a call on that early in 2023. But when Jamie Dimon was talking about it, he equated it to a hurricane. And instead of it being like a category 4, it would be a category 1. And so we feel, and we're not the only ones, that, some of the pain in the markets has sort of already been priced in. And it's not going to be a shock, and say it's Q1 of next year where we say, hey, we're in a recession. Well, everybody's kind of expecting that. So what 2023 holds in terms of returns on the S&P 500, we obviously don't know. No crystal ball. But I think if we get a Fed that pivots, whether it's Q1 or Q2, and says, hey, we're not going to raise rates anymore, that's going to be a good thing. I don't know if I'm going to get this saying, exactly right. And I know we're going to talk about crypto in a little bit, but, bull markets usually start when everybody's pretty worried about the markets, and they die in euphoria. And we can talk about that a little bit more with crypto, because that was certainly a euphoric situation. But, 2023 could be challenging. We don't believe it's going to be like a 2008 and it's going to be, be a huge down. But we don't know for sure. I did get one historic fact. Apparently, according to one of my investment analysts, who keeps me up to date on these things. The third year of a presidential term is usually the best in terms of stock market returns. So we need to hope that history repeats itself next year.
Yeah. And, we keep politics off the show, and I'm not, I hear what you're saying. I don't know, and again, I don't like to get into the politic debate and conversation. But, I look at the facts. I don't care, who is really, well, I do care, but as far as running the show, but I look at the facts, and we are so propped up. I don't know who can bring us out of what we are without seeing some kind of a major correction. And, not that I'm trying to be a doom and gloom guy, because you know what? I've seen a lot of ups and downs in 33 years in business. And, I've seen a couple stock market busts, right? I can remember, back in 2000, and just crazy stuff, that's happened through the years of my career. But I know, and one of the things, I guess, and along the line, so I don't want to talk about politics, but let's talk about it for just a tiny bit, because I do understand the position, right? I do understand the position of the administration, right? So it's like you're kind of in a position where you don't want things to be so bad and ugly, because that looks really bad, right? You want to be able to say, hey, we've gotten through this and the economy is booming, and, because you don't want to be sitting at the end of the day, with your job on the line, or jobs on the line, period, and them saying, well, you did a bad job of getting us out of this. And, and the administrations have changed through the years, and it seems like every president has been dealt with, or new administration has been dealt with, whatever, good or bad, that has occurred in the last term or whatever, or term prior to the turnover. But, I think one of the biggest things that disturbs me so much about this all is that we're really not talking about the amount of money that was printed. And, when we're looking at, through the pandemic, and I get it, right? Again, we're talking about Monday morning quarterbacking, right? So we're looking back at the back snapshot. And I don't know where we are. We're back. We added so much stimulus, and I don't know if we dropped out on you guys or not. But anyway, we added so much stimulus into the economy and printed so much money in 2 years, more than we have in 200 years. So I guess, Josh, my big thing is, man, how do we get that cash back if we're going to keep our economy running strong? And a lot of the stock market, because you can get whatever economist you want to say, and a lot of these are bureaucrats. They're going to say, and I've interviewed them on the show, and and no disrespect to them, but a lot of them are like, oh, it's rainbows and sunshine, and but we know that they have agendas, and we know that they're working for whoever it is that they're working for, that is trying to keep the sentiment high, because the last thing they want are shareholders pulling out. And when we're talking about stocks and shares and companies that are publicly traded, and we're talking about, they want the shareholders to feel good and keep their investments going, right? But how do we do that? How long can you keep propping up the economy and saying, the Fed's going to pivot, and the Fed's sitting there, Jay Powell, he's like on the hook here, man, saying, you know what, we're going to stay strong. We're not going to pivot. We're going to keep this pressure on pricing. We're going to keep the interest rate. He said 5.1 was a target rate for next year by the end of the year. And then by the end of 24, he was talking about 4.1 as the interest rate. So to me, I'm looking at that going 2 years. And then people like you and me, and that are dependent upon people having cash and investing, right? These people are dependent upon we're dependent upon people having money, right? And so, I mean, what do you think? I mean, what do you think? Do you think the Fed's going to pivot?
Well, we do think they're going to pivot. We have an investment team internally that one of the things that's great about our company is while I'm an advisor and I'm advising clients, I'm not the one necessarily watching everything day in and day out. We have a team that does that. And we do think they're going to pivot. I mean, they are, inflation is they're trying to kill it. So far, they're doing a pretty good job. You did say something I thought was really interesting. They do want to come out and say things and try and keep people positive. But I don't know if you've noticed this, but like last week when Powell came out and said, "Hey, we're going to have an economic downturn in 2023, but I wouldn't call it a recession." Did you see how negatively Wall Street reacted to that? Because they're not really, they're almost listening to what he says and then doing the opposite, right? So when he says something really rosy, there's not a very good return in the market. When he says something, negative, they're reacting positively to it. So it's almost like this bizarro world where bad is good and good is bad, But yeah, we do believe they'll pivot. I mean, if we knew exactly the time and date, we could make big bets on that, but we don't, and we speculate obviously. But no, we do think they're going to pivot. There's a lot of people who think that they're going to, not only are they going to stop hiking rates in 2023, they're probably going to lower them in 2024. Because they'll have to come out of a recession if we have a true recession call. But that's just our opinion, and we don't know for sure. But that's our thought, that they will pivot in 2023 at some point.
There's a lot of, I guess, discussion and questioning of how they come up with the CPI, for instance. As far as being able to say that, that we're actually, coming out of inflation, that inflation's better. Do you trust the way that they collect data? I mean, there's, a lot of people say, the way that they're collecting their information is very backward looking. And I know shelter inflation is a large part of CPI. And it's a huge, I mean, you have, and a lot, and with that, it seems to me that when Jay Powell is talking about inflation coming down, he's very specific to say excluding things like food, right? And utilities, right? Things like that. I mean, that's a major concern because it's like you said, you just said it's not what they're saying, it's what they're not saying. So if they're saying one thing, you're looking at, okay, what aren't they saying, right? So I look at it and I go, okay, I know for a fact that the people that we're helping as buyers, they have less cash than they've had in years, no cash, a lot of them. They're financing their groceries or financing their fuel. So what I'm thinking is, are we getting the straight numbers? And, how much of it is propped up because we have an election coming, or how much of it is, they want to try and keep us on the positive side of things. We've printed more money in 2 years than we have in 200 years. Mm-hmm. How do we get inflation down without taking back that money, getting rid of the money that's on the street, they need to get the money back, right? To really drop, I mean, right or wrong?
Yeah. I mean, in terms of the data, do I trust it? I mean, to a certain extent, you kind of have to trust it, right? Unless you know that the data is not accurate. I mean, I think most people judge inflation by what you're talking about, the grocery store, their power bill, and, is their rent higher than it was before, right? And so we're definitely not at a point where it's been completely crushed. I mean, in terms of getting the money back, you could go a lot of directions with that. I mean, I look at very subtle tax things. For example, changing the rules on inherited IRAs, which is something that people didn't really, I don't think, take notice of, because if you don't have an inherited IRA, why would you even notice? Right. So it used to be that if you inherited an IRA from a non-spouse, you had your lifetime to take that money out. Well, now you have to take it out within 10 years. So you took a tax burden that you could spread out over 30 years, and now you condense it to 10. There's a lot of ways that, they're looking at potentially getting rid of Roth IRAs. I don't know that that'll happen, or backdoor Roth conversions, things like that. So, I mean, taxes is one way in the future. How do you get that money back, though? I mean, it's hard to say. And then, again, back to your point about the data, they do go out of their way to say, these are the numbers minus this. But you kind of have to trust the data that's out there, unless you have something more concrete that says it's, not in fact correct. So
how much dependency does do a lot of these companies that are on the stock exchange, how much dependency is based on sales and transactions through the holiday season?
I mean, it's pretty big for retail, obviously. That's a big component of their bottom line, for sure. And
you
look,
think it's an indicator?
I think it can be one indicator, sure. And like it or not, I mean, we are a consumer spending economy, right? Like if we don't spend, the economy doesn't work. We're not really a manufacturing economy anymore. People have to spend money, and unfortunately, a lot of people spend money they don't have. That's one of our problems. And not to go on a soapbox, but I was talking to a young client today, 25 years old, does very well, work with their family, and she made the comment, why don't we learn about this stuff in school? It's a great point. Maryland still hasn't made it a requirement to graduate high school. It should be a national requirement to have, basically have basic financial literacy.
Yeah, I'll agree with you on that. Let's take a couple questions here that we have flagged. Dealing with stock. Here's a stock question here. Jeff is a avid viewer of our show. We appreciate you, Jeff. Apple is way overrated. Apple is about to get smoked. Any opinions on that?
So we don't specifically cover like individual securities per se. I think Apple has a good track record. One thing you'll hear from me if you're a client of mine, and I see this quite often, if you were to name probably like the top 5 stocks that people have an over concentration in, Apple would be in the top 5 every time. I have clients who have an over concentration in Apple in accounts that we don't manage. And it's a conversation every time we meet. Hey, you want to diversify some of that Apple stock into other things? But, I think as long as they're making iPhones and people are buying them and buying iPads and that type of thing, and Apple TV, I think it's a good company overall. But again, as a part of a diversified portfolio, not as a outsized holding.
Gotcha. Some of these companies get so big and we think that they would never go down. I can tell you, companies like GM, right? Think about it. They were like it, man.
Mm-hmm.
And so here's one. Tesla. This is Travis, Real Estate Mindset. Travis, we appreciate you, buddy. He's got a great YouTube channel too. I'm sure a lot of our audience follows him. If you have never heard of him, check him out. Talks about the real estate world, just like myself. So what's your opinion on Tesla?
So again, we don't pontificate too much in individual securities, but if you just follow it, right? I think the term Jeff, the last question said Apple was getting smoked. Tesla has been getting smoked recently. And, some of that is probably based on the bottom line, and some of it is based on their CEO and his purchase of Twitter and his opinions on many different things. And, like him or not, he's a brilliant guy. But, what's the succession plan if something happens to him, if he gets too focused on Twitter? Again, this is why you have a diversified investment portfolio. I recall having a conversation with a gentleman a couple of years ago who wanted to work with me and said he only owned Boeing stock. And that was right before they had the problems with the 737. So, again, as a long-term hold, Tesla might be a fine thing to own, but, not something that you should have a heavy concentration in.
I mean, look, he has done amazing, right? Elon Musk. I
Mhm.
think there's no doubt. I mean, he's a bright person. I mean, he has a lot of technology that he has, pioneered and continues to pioneer. And every now and then I'll catch a podcast with him, and I'm always fascinated by his thinking, the way that his forward thinking. But yeah, I always look at the practical side. And I can remember an interview where Jeff Bezos, they were talking to, about Elon Musk and his space travel and exploration and living on Mars. And I remember, Jeff Bezos said, try living a couple months on Mount Everest. And, basically, if you like that, then, maybe you would think about living on Mars. But, I always think about the practicality of, I mean, it was last year on, there was a big ice storm and all of these electric cars were stuck on the highway because there were traffic jams because of the ice and accidents, and people were stuck. And I think about, how practical is it for us when we're so dependent upon, utilizing transportation to get things like our food, for instance, or all of these goods and services, or services that are dependent upon goods by, electric. And I always think that though it sounds great, and I'm all about a greener planet, I wonder about, what the practicality is of all that. Let's see what we got here. I need my glasses for this. Excuse me, guys. This is the part of getting over 50. Josh Rivers. Will Wall Street invest in? Where will Wall Street invest into next, since real estate is going belly up, second time in the 21st century? And this is a good question.
Well, I mean, I would think that Wall Street would try and, be diversified. I mean, that's something we preach to all of our clients, owning multiple asset classes. I mean, I do think, I'll go back to what we were just talking about. The clean energy, I think, is certainly somewhere where Wall Street could put a lot of money going forward. I mean, clearly, the current administration is fully behind, essentially like a Green New Deal. And I do think there's a long road for that being, the primary source of energy. I mean, an electric vehicle right now is still not affordable for the average person. You're looking at $60,000 plus for one of those vehicles, where, you could buy, say, a Hyundai Sonata or something like that. That's a fossil fuel burning car for 35,000. It's a big difference. And I think until the technologies of solar and wind and all these things, until they become more affordable, they're not going to catch on as much. But I think that there's certainly a huge opportunity for investment in the future in Wall Street. Socially responsible, environmental investing, that is definitely something that's becoming more and more popular. And, the folks who are committed to that now, they're committed because that's not been a great place to invest, particularly this year. I mean, the best performing asset class in 2022 is energy, and not alternative energy, fossil fuels. So I think that could potentially be a big place that Wall Street would would invest. But we'll see.
Yeah, I can tell you, I haven't, I haven't been very lucky, I guess you could say, when it comes to my investing in stocks, securities. In fact, oil and exploration and natural gas was something that I was really kind of into. And of course, what has happened over the last decade with that. But there has been a lot of rebound in it, and it's kind of wondering, will I ever get to the point to where I can get out? I don't know, or whether I would even want to, because I agree with you. I think that our dependency on fossil fuels is not going to be an easy one to get out of anytime too quickly, though it sounds great in nature, but there is that practical and affordability side of it. And what we're seeing is that in the real estate business, there are laws that are being presented, bills that are being presented that in some states are approving them, where they want to take fossil fuels out of buildings and real estate, and the burdens that is going to put on a lot of the building owners to do these expensive, retro fits to really make these changes, or they're going to be looking at large penalties and things like that. Real estate has taken a hit. I mean, Blackstone or BlackRock has been in the news a lot with their REITs, and we see that they're also saying that they're standing by to buy even more real estate. What's your opinion on these large companies when we're talking about shelter inflation? And this is a good question here. And Charlton he's a regular follower as well for us and comments quite often. What is your opinion on whether we should be even dealing with our shelter, our basic necessity of the roof over our head? Do you think Wall Street should be in this industry, buying up and gobbling up, all of this real estate, to especially single family rentals?
I mean, personal opinion, I don't really like it, because I think homeownership has been a cornerstone of building wealth in our country. And I think it's making it harder for the average buyer to, participate in that. I think they're largely doing it because we've been in kind of an environment over the last, say, 20 years where there's been no yield, right? So bonds, this is why bonds have gotten crushed this year. We're raising interest rates, and when you raise interest rates, bond values go down. We've been in a very low yield rate environment for a very long time, and I think they're looking, and they're not the only ones. You see a lot of private equity firms are buying like dental practices and veterinary practices as income producing assets, and that's why they're buying homes is income producing assets, because bonds have really just not been that for quite a while. So from an investment standpoint, it's a great idea for them, but I don't really like it personally, because again, I think it's making it harder for the average person to have the American dream of owning a home and building that home equity and building generational wealth. So personally, I don't love it, but from an investment standpoint, it makes a lot of sense for these large companies to do that.
So when Jay Powell is saying that we need a correction in housing or in rentals, right, and the rental expense, we need a correction. We take it as we need prices to come down. I mean, there's two things that could happen. Either we have rapid wage growth over the next 12 months or so, or there are going to be a lot of people, especially if we do have a recession, where jobs are, and we're already seeing major job cuts, man. Amazon, 20,000, they just announced. When we start seeing, people getting laid off and things like that, and we start seeing, the interest rates going up and the down pressure on pricing, Wall Street or any I guess, institutional buyer that bought housing for cash flow. Once they start to see that, if the downward pressure starts to affect profits and they start getting into more of a loss, because let's face it, I mean, real estate's an expensive asset class to maintain. I mean, it's not like, running a business. If you have a business, let's just say like, Amazon, yeah, there are costs of doing business, but you have a lot more control on the operations, right? I mean, the ownership and the board, they can directly, impact a lot of, what's happening with the operation. With real estate, you're using a lot of subcontractors, and there are a lot of expenses and costs that fluctuate. It's hard to predict. It's not like, putting something together, right, so easily. So when they start to see losses happen in their real estate sector, what do you see these companies doing? Do you see them like Open Door starting to liquidate the assets, flooding the market with inventory, selling them at a loss in order to generate cash? I mean, these companies need cash to operate. So how do you think, if we start seeing shelter inflation, the downward pricing reduce rental rates, how are these companies going to absorb that and survive?
So my guess, you obviously know a lot more about real estate than I do. My guess is that from a risk management standpoint, they have priced in a certain level of reduction in rental income, and they probably have a threshold. I don't know what that threshold is. I think a little bit about back in 2008, you had all these collateralized debt obligations, and that's what, kind of set Lehman and folks like that underwater and out of business. I worked at the time for a family office, which is very high net worth individuals that, own a lot of non-traditional assets. And one of the things that some of the managers that we used at that time did very well in was buying that distressed debt, because they knew that a lot of it, although it was kind of bundled in a package and was marked as distressed, say 70 or 80% of those loans were never going to default. And they knew that if they had a certain default rate and they stayed, under that, they could make money on that. So my guess is that, some of that investment into real estate, they've kind of priced that in to say, we know a certain level of pressure is going to occur. And as long as we stay, kind of above that threshold, we're going to keep it as long as it's cash flowing, right? If it stops cash flowing the way they want, I mean, yeah, I would guess that there would probably be some, liquidation and try and getting those properties off their balance sheet. But again, this is sort of a newer investment strategy for these large investment banks and investment houses to do that. But those are sort of two scenarios I could see potentially taking place.
Well, one of the things is they've really probably never experienced this before. So like you said, I mean, when they were buying these bundles of loans, this, underperforming, asset, they were buying it for pennies on the dollar. I mean, they were really, and then really, I mean, we're talking about really 2011, 2012, when the administration put together this, package for these large investors to get into residential rentals, right? I mean, all these neighborhoods were declining. There were tons of board ups, hundreds of thousands of foreclosures, and and I mean, they needed somebody to cut the grass. I mean, it was just costing these banks, and so all of these defaulted loans and mortgages and were packaged and sold with the promise that these investors would keep it for a certain period of time and turn them into income producing properties and rent it back to the people, fix them up and rent it to a certain point and rent them back to the people that lost their homes because they needed a place to live. And really, since 2012, we've seen nothing but price appreciation, especially over the last 2 years. I mean, it's been crazy. And we also know that in certain markets, over 30% on average of the houses, single family houses that were purchased in the last 3 years were to investors. And we know that these investors were competing with homeowners and paying top dollar. So, a lot of people attribute, like you said, I mean, should they be in this business at all? I mean, you have people that want to buy a home because, Josh, how many people you don't serve, right? The people that you do serve or that your industry serves to help people invest their money. For many Americans, the only investment that they've ever had or planned on was owning a home, buying
Yeah.
a house. It was their only investment. That was the dream, right? That they would have that money, that equity in their home for retirement or to sell it or to pass it on, things like that. So, it will be interesting. It's, one of the things I want to talk about. Let's see if we have any more. And guys, we want to hear from you. If you haven't asked your question, here we go. We got another question here. If Fed pivots and we haven't seen prices come down, the dumpster fire will follow. And Josh, I'll let you take this one, man. But you know what? This is what a lot of my colleagues, okay, in the real estate industry, and I have this conversation with colleagues all the time because they say, Todd, why are you talking about all this stuff on, why are you coming out as a real estate broker and talking about these things? We want to be positive and we want to be selling, and it's always the best time to buy real estate and, dive in. And, and a lot of my colleagues, they were like, hey, what, inflation's coming down. The Fed's going to pivot. We're going to see interest rates 4% at the beginning of 23. And everybody, we can be hopeful for that, right? We can think about it. And I don't think it's going to happen. But one of the things when we're listening to the Fed, we're going, if he lays off the throttle, if he pulls back, and though, that overnight rate that we're talking about with the Fed, that doesn't really trickle down. It affects more like credit cards and revolving debt and consumer loans and things like that. It really doesn't affect mortgage so much. But it does follow the same trends, right? Because we're talking about 10-year treasury notes. And so mortgages can go up when when the Fed rate goes up, mortgages tend to go up. When it comes down, mortgages tend to come down. But and interestingly enough, when Powell just raised rates, we saw a dip in mortgages. And, and of course the industry's like, see, mortgage rates are coming down. We've always seen mortgage rates dip down this time of year. I mean, it's been like historical. It's like you can bank on the sun coming up in the morning. You can bank on mortgage rates coming down in December, because we try and stimulate some activity in the off season, because winter's usually an off season in real estate. But do you think, like, this question here, do you think if the Fed pivots too soon? And by the way, Jay Powell has said, we're not letting up on this throttle. I think what we're going to see is when the real numbers come out, I'm not as hopeful that inflation has dropped as much as we'd like to think. I think we might actually see, because real estate's lagging, once that number comes out with real estate for, these last couple months, I think we're going to see that inflation's higher than what it is. But anyway, take it away. What do you think? The Fed pivoting, backing off like you're hopeful for, and I don't know whether I'd like to see it.
So we think he's made it pretty clear he's committed to killing inflation, and he's probably going to give it a couple extra blows to make sure it's dead. And so, when they pivot, if for some reason they pivot and they're wrong and inflation's not under control, of course that would be bad. But we just don't think that we're going to get there. We think they're going to kill it, and they're going to thoroughly kill it. We think it's close to dead anyway. But no, I mean, if you were to get to that point where they pivot and in fact it's still not under control, I don't know if I would use the word dumpster fire, but that might be a good way to describe it.
So let me ask you this, because along that way, you said that you think that they've pretty much killed inflation, that they've killed it. And I know certain industries we have not seen the kind of real estate correction that a lot of people feel that we need, right? So when we're talking about a lot of the thought in the industry is to get back to an affordable level, because wage growth really has not changed much in the last decade,
Right.
right? I mean, as far as people making money, right? I mean, we certainly have wage growth has not been anywhere close to where inflation has been. So I see higher consumer debt than we've ever had. I see now, because of the high consumer debt, that with inflation, it's going to make it harder for these people. I see banks making tons of money, and on debt, and when we talk about inflation being dead, what I see, and when they're talking about unemployment still being low, and they talk about 1.7 jobs per unemployed person, I think of that as like ridiculous. Like, maybe they're not qualified for those jobs. Maybe those jobs that are out there wouldn't cover their bills. So I don't really, I don't think that, to me, makes a whole lot of sense as an employer. 1.7 jobs per unemployed person. But when we talk about a correction, a market correction, I think about, we need to, typically we felt a lot more pain than what we felt right now. I mean, I don't really know that inflation is dead, because I think that we've gone up so hard and so fast and so out of control that when you just look at it from a standpoint of, I think mortgage interest rates, 7% historically is a decent rate.
Mm-hmm.
When you're going back 40, 50 years. On average, 7.7%, I think, on average, right? Mortgage rates, 30-year fixed mortgage rate. But we can't say that today, because in order for that to be affordable, I mean, we've seen the housing affordability index drop significantly. National Association of Realtors just released October data. We're in December now. Housing affordability has dropped significantly. So if he pivots, or if we see, interest rates would literally have to go back to 4% for people to be able to afford the houses that are out there. And still yet, there's not much inventory. So I don't know.
Well, I saw a stat today, and you're the real estate guy, but I saw that since, I think it's July, the S&P is up like 5%. Home builder stocks are up 15%. The home builder sentiment's gone down every month of 2022. So every month it's gone down lower. Clearly you have an inventory problem. I live outside of Annapolis, Maryland, and when you go on the whatever, with the MLS or whatever, the listings, there's no availability. There's no homes available. So it is a problem. The inventory is clearly a problem. In terms of the pivot, again, they've sort of said that in 2024 they could lower rates. So I think you could potentially be at that 4%. Again, no crystal ball, by 2024. And so
that would crush things. That would crush. If you just take it basically from what you just said, and I agree, inventory is low. In order to get pricing down historically in the real estate business, and there is a historical cycle in real estate, and prices usually correct or become more competitive when we have a glut. And that's the typical cycle in real estate, right? You have a glut, you have oversupply, right. You have a glut. And right now we're not seeing that. Man, if they drop rates back to 4% for mortgages, we're going to see, with little inventory, we're going to see house prices skyrocket.
Right. So, again, I'm not good on the mortgage rates, but I think, you've got an inventory problem, clearly. And yes, houses are not as affordable with the rates that they're at now. Like you said, 7% historically is not that high. My first mortgage was 8%. I was thrilled when I refinance at 6,
Me
So,
too.
yeah. So it's a problem, but it's funny too with this market. I mean, the stock market, and let's separate the stock market from the real estate market. That's again back to this inflation thing. That sign when Powell says we're not going to raise rates anymore, we believe there's going to be a pretty sharp move to risk assets, right? So like the market, and how quickly that affects the housing market, not totally sure. You might see the stock market recover before the economy recovers, right? It's a very strange time. It's the strangest time in my 23 years because so many of the things that we would kind of normally say, yeah, we're looking for that. It's like you're looking for the opposite, right? Like you talked about employment. I mean, we got a good employment print like 2 weeks ago, and the market was like, we don't want to hear that. That's thumbs down, right? Because if we get a bad one, that means things are getting, we're crushing demand, which is what they want to do. So it's just a really strange time. And again, I think it's all about the Fed, and it's all about rates and when do they pivot and what does that look like?
Well, one of the things that I want to talk about here, and I want to this is kind of juicy, man. Because I have so many friends of mine that are in this, and you know where I'm going with it. But
I
want to talk
so.
about crypto. I want to talk about cryptocurrency and Bitcoin, and I mean, obviously, FTX was a huge blow, right? Took a lot of people out. And I know, now we're hearing, criminal charges and all kinds of investigations and all that kind of stuff. But I want to talk about two things. I want to talk about your opinion of crypto, because I have friends of mine that have been in it for a very long time. And if you invested in Bitcoin back in the very beginning, and I was there in the beginning, I remember my banker buddy, where I banked, he was the in-house stock guy, right? And he helped me with some things. And he's like, man, you got to buy this Bitcoin. And I'm kind of wishing that I would have back then, because who would have thought, right? If you invested when it was like 0.0007 or whatever it was crazy, right? To what it's trading even now, being a fraction of where it was. A lot of people are banking, especially our younger generation, are banking on a complete collapse. And if you want to think about Bitcoin or cryptocurrency, I look at it as, what do you really have, right? I mean, as we know with this FTX, as it wiped out. I know if I have a couple dollars in my pocket, I have the couple dollars in my pocket, right? But if I have this, digital wallet and all of a sudden it gets wiped out, it's gone. But there were a lot of people that were really believing that we would have a currency collapse, right? Mm-hmm. And what I've said to people is like, man, you have to really think this is going to be like the collapse of like the Roman Empire. I mean, in order for crypto or, the like, we would have to have zero faith completely in our, financial system. But give us your opinion on crypto. I know you and I have talked about this, and you've said that, well, go ahead. You give us your opinion on cryptocurrency.
Yeah. So, I mean, as an advisor and as a firm, it's not something that we've invested in for our clients. And, a lot of my clients are 50 and over. I'm not going to say they're completely risk averse, because, they all have different levels of risk tolerance, but it's not something, ironically, that anybody really asks that much about, other than, hey, I don't have that in my portfolio, right? That's sort of the only questions I've really gotten about crypto. I mean, it's its own asset class. People talked about it being an inflation hedge. Well, clearly not in this case. But it's really not like anything else. I mean, people have compared it to gold, but it's not really like gold. It's not really like owning a stock. It's really kind of its own asset class. In terms of an investment, I think if you have a long time horizon and you're willing to stomach a lot of risk, if you wanted to maybe have a under a 5% allocation in your portfolio, that could be appropriate. But you have to realize that it's going to be extremely volatile, and you might end up losing a lot of that money, or you might end up making a ton. I mean, like you said, if you got in at the beginning, you would have made a lot of money. My son, who's 11, told me about a guy who bought a pizza a couple years ago with Bitcoin. I think it was in 2012, and it was, I forget how much Bitcoin it was, but what it was worth now, or back when the price was higher, was something like $500 million or something like that. So it's
he paid a lot for a pizza.
He paid a lot for a pizza. That pizza better been really good.
Yeah.
So it's not something that we invest in at this point in time. But again, I think for a certain part of your portfolio, a certain percentage, as long as you understand the risks, you could do it. But it's the blockchain technology. I don't think most people understand it. A lot of investment advisors would say, don't invest in something you don't understand. And I don't think most people understand it, including the people who are investing in it. And you and I had talked before about, bear markets and bull markets, and bull markets usually start when investor sentiment is really bad, and they die in euphoria. And I would say that, it was a pretty euphoric state with cryptocurrencies kind of before about the last 12 months. I mean, everybody wanted a piece of Bitcoin and Ethereum. And, I had people who I knew who were not investors who were like, oh, I'm buying coin. And I'm like, you don't even have a 401k. Why are you buying cryptocurrencies? So, and then, it's kind of interesting. Like, we live in Maryland, and I don't know if you've noticed, but I feel like the only thing I see on social media right now is people doing online betting. There's some euphoria there. And I don't want to see what happens when that kind of crashes down. I think it's going to be a similar type of thing. But usually when, there's euphoria about some type of investment, that's probably the worst time to buy it.
Do you think, there's a lot of talk about the government maybe making cryptocurrency illegal or banning it?
So I've heard that. I think that could happen, I guess, but I think it's more that needs regulation, right? Like, so in your business, there's a ton of regulations. In my business, there's a ton of regulations. Rules about custodying assets, transparency on your fees and transactions, and there's just so much regulation in our business and in your business. That's not the case in the crypto world, right? And even with regulation, it's hard to legislate morality. So if it's pure fraud, I mean, it's kind of hard to completely stop fraud, but you can certainly greatly deter it by having it be regulated. And that's just not the case in that world right now.
I've pulled up here on September 16th, 2022 on whitehouse.gov. They have a fact sheet that the White House releases first ever comprehensive framework for responsible development of digital assets. Do you know anything about that?
Honestly, I don't know a ton about that. I do know that the SEC, is getting involved with this FTX thing, which is a good thing. Again, there needs to be more regulation to it. It's kind of the wild, wild west right now.
Yeah. Do you think it will be the government's goal, or do you think it's the agenda to get rid of cash?
That's really hard to say. I mean, I think you could see that at some point, but I think we're a ways away from that. If it were to happen.
How far?
Oh,
will
I
it
think
happen in our lifetime?
It could happen in our lifetime, but I think we're probably decades away from that.
Yeah. I mean, I don't carry cash, man. I mean, I think everything's plastic, right? I remember, if you go in and you have cash, a lot of the businesses don't even have the change to give you You know,
That's true.
I mean,
That's true.
try pulling out $100 bill, man. They're like, sorry, we can't cash that. Well, give it to me for free then.
Right.
All right, let's take this. This is Danuska. Danuska is a regular follower of our Tuesday night podcast. We appreciate you. Good evening, Josh. And which sectors? And, we've kind of talked about, all these things that are happening and good and bad. And, so I have friends of mine, they're like, oh, well, we just need to buy gold. We just need to buy silver. And, I don't know. I haven't had anybody buy a house with gold bars yet. And I certainly haven't seen anybody at the grocery store pulling out a bunch of gold coins in their pocket. And so, but everybody wants to know because, one of the things that we realized, and we just had a video on this, that the Fed, one of their responsibilities has always been, they have like 3 tools in their toolbox. And one of their responsibilities was that banks had to keep a minimum reserve in their vaults.
Mm-hmm.
And, to protect customers and the bank for what we've known in the past as a bank run, right? For a lot of you guys,
Right.
If you don't know what we're talking about, the Fed, one of their jobs was to make sure that there was a certain percentage of deposits. So if a bank, for instance, let's just say, they're holding $800 million in depositors' money, there was a certain percentage of that they had to keep in their vault overnight, that if people became wary of the bank, thinking that maybe they were financially insolvent or maybe they were making some bad decisions or they just didn't feel comfortable with the bank having their money, if a large group of people all of a sudden walked into the bank and said, I want to withdraw my money, take my money out of the account, there was a certain amount of money that was required for that bank to keep. And then, we learned that back in, I think it was March 26th of 2020, the Fed reduced that reserve to 0%, which basically eliminated the requirement for the bank to have any money in their vault for things like a bank run or something like that. And it's very interesting. I didn't know it. And so, a lot of people are saying, like, what do we do? What do we do with our money? If the stock market is in the news of we're seeing things like on CNBC where, the millionaires are saying, hey, we're going to see, a 10% decline in stocks. Well, people might say, well, I don't want to put my money in the stock market because, like real estate, if it goes down in price, then I've lost day one almost. I don't want to go buy gold bars because what's that going to do for me? I can't, number one, it'd be risky to have it. Number two, I can't just go and buy a mattress with a couple gold coins. What do people do, man? What, like Danuska's saying here, what are you telling people if they have money, if they have cash, if they're uncertain, they want some kind of a, there is no guarantees. What do people do?
Well, let me answer her question first. I mean, so some of the things that we like right now, we do love energy. In a lot of our client portfolios, we're overweight energy, and not alternative energy, your classic fossil fuels. We like the valuations on energy. We think that those are going to remain strong going forward. We like small caps, actually. We like small caps a lot right now. The valuations compared to the S&P 500 are very favorable. So those are 2 asset classes we really like. I mean, there's other things as well that we own, but those are 2 we really like right now. I mean, in terms of, you're looking for somewhere to put your money and you're worried about the stock market. I mean, obviously our business is investing. If you look historically, there's a great, I'll call it a third party piece. JP Morgan puts out a lot of good material. They have 2 pieces that are both free. You can go on their website and get them. One is their guide to the markets. It comes out, I believe it's every month. It's got some great, it's about 70 pages. It's got some stuff that's really basic and really good. It's also got some really, kind of probably going to go over some people's heads stuff, but it's really good information. And then they also have a piece called their Guide to Retirement, which comes out once a year. So one of their best slides in their Guide to Retirement that came out this year is talking about staying invested. So it looks at the S&P 500 for a 20-year period ending at the end of last year. And if you were in the S&P 500 that entire time, your average rate of return is like 9.5%. If you missed the 10 best trading days over a 20-year period, your return gets cut almost in half. It's like about 5%, right? And as you kind of keep going down with missing these trading days, the return gets worse, right? I don't think it's always that hard for somebody to say, wow, the market's really bad. I'm going to go all to cash. The problem is knowing when to go back in. And so if I were to, if Todd, you were my client and you said, hey, Josh, right now the S&P is down almost 20%. I want to go all to cash. Well, one of my questions would be, so if it goes down another 20% and I call you and say, hey, let's go back in the market, what are you going to say? And most clients are going to say, no, I'm not going to do that. Right. So knowing when to get back in is really the hard part. And the other thing about that chart that I just mentioned is that a lot of the best days in the markets and the worst days are very tightly clumped together. So we had that this year. We had, I think, the second worst day or the worst day in the market and the second best day were in consecutive days, right? So missing those rebound days they can add up and can really hurt your long-term return. But if a client is saying, I want to go more heavy in cash, we do advise our clients to have a certain amount of cash, usually 3 to 6 months of living expenses. In our portfolios, we don't hold a ton of cash. But if we're kind of getting more conservative, it would be going on like the short end of treasuries. So maybe buying like shorter term treasuries, that type of thing. I for a period of time was an advisor in banks. I remember when you could get a CD at 6%. It was just, that was pretty normal. And we're not there right now, but we're certainly, the yields are a lot better than they used to be. And then one thing, that I think a lot of people don't know about, and unfortunately you can only buy a limited amount, but one thing that's been, a lot of our clients have bought recently, and not something that we manage, but something that we've educated them about, is I bonds. So I bonds have been, a good, the most recent ones that ended in October, the yield was like 9.6% or something like that. Really, really high. Right. Unfortunately, the Fed doesn't let you buy too much of them. You can only buy 10,000 a year per person. But yeah, I mean, you also said kind of there's no really quote unquote safe place. You put money in the bank, you got to rely on the bank being solvent. So we believe in being diversified. A lot of the investment decisions we make for our clients are based on their financial plans too, right? So we kind of look at 3 things that are going to determine whether your plan works. The one we have no control over, that's how long do you live? We have no idea how long our clients are going to live per se, but how much do they spend and how much have they saved? And a lot of times we can look at a plan and say, you know what, you could have a little extra in cash and you're still going to be fine because you're going to be able to weather these market ups and downs. But yeah, not putting money into the mattress. And, I know there's people who love the physical gold, and that's not necessarily a bad investment, but I always wonder, if you buy a bar of gold and you need to do it, are they going to have change? Right. That's always the big question for me. Are they going to have change for your gold bar? So,
or do you buy the $500 million pizza or whatever? Right.
Right.
Exactly. So are you skeptical at all on some of the banks that are out there? I mean, a lot of people say, well, there's a FDIC insurance that protects, $250,000 per account holder. And I think maybe if you're a joint account, maybe it's $500,000. But I have friends of mine that are in banking, and they say, though, this is true that there's an FDIC insurance, that they've told me that there's nowhere really written in that policy that there's a certain time period that you will get your money. So, if a bank goes bust, when would you get your money? And, so, if you were, do you have any skepticism with banking being insolvent? Are you concerned at all that there now is, there's no minimum reserve that the bank has to keep on hand in cash? And, should somebody, if they're, 3 to 6 months of cash could be substantial chunk of money, should they put it in different banks? And what do you tell people with that?
Yeah, I mean, ideally, I think if you're talking about large sums of cash, I do think it makes sense to diversify across multiple banks. I would not say I have any really major concern about the insolvency of the banking industry or any banks in particular. I think their balance sheets, while yeah, they may not be, I don't know every bank's balance sheets, but I think they're certainly a lot cleaner now than they were, again in 2008. So I wouldn't say I have any strong concerns about that at this point.
Yeah,
I do hear a lot of people say that they prefer the smaller banks, to the larger banks. I personally bank with USAA because it's a company that I like and I've had a great experience with, right? But no, I don't really have any concerns about the banking industry in particular.
Yeah, well, we'll take a couple more questions, guys. So if you have them, go ahead and comment them in. But before we do, I mean, Josh, we are really grateful to have you on our show. You're bringing a wealth of great information to our listeners. Tell people, can they get a hold of you? I mean, we'll publish your information in the show notes. I mean, where can you help people? And obviously, I'm sure if people are interested in investing, you want them to reach out to you. But can you help people in other states? Is it just Maryland?
No, so I have clients all over the country. We have 6 different offices around the country. Obviously, since COVID, we do a lot remotely, a lot of Zoom, that type of thing. But we are still taking clients. I am still taking clients. We do a lot of planning as well as the investment side, looking at clients' estate plans, their cash flow, looking at strategies like Roth conversions, charitable giving, all those types of things. So we try and be very comprehensive in looking at a client's entire financial picture, not just their investments. But we also do a great job on the investment side as well.
Excellent. Well, we'll make sure that all your information is published. And guys, we encourage you, if you're interested in learning more, and there's so much we haven't touched on. And we have a lot of clients that, they buy real estate with self-directed IRAs. And, I mean, there's a lot of different vehicles and things that, so, I encourage you to reach out to Josh. As you see, guys, he's a wealth of information. So we'll take a couple more questions before we sign off here tonight. Do you like the Dividend King stocks? And I have no idea what that is.
So I'm not exactly familiar with what the Dividend King stocks are, but definitely like dividend paying stocks, right? There's, many schools of thought about how you kind of take income from an investment portfolio. That is one of them, buy dividend paying stocks and live off the dividends. We have a strategy within our firm where we have a dividend growth strategy. So we love dividend paying stocks. It kind of depends on the client's risk tolerance, what their goals are, but absolutely dividend paying stocks are a great thing to invest in. Those are very quality companies. And if there's ever been a time to own quality, now would be a time to own quality.
Excellent. I don't foresee residential real estate rents going down anytime soon. Property taxes, insurance, and maintenance costs have risen. I'll attest to that. I just got my, I have real estate, I have rentals, and I just got my insurance renewal. And wow, I was really surprised at how much it has gone up. All right, Josh, do you expect the stock market to hit new lows? I think we covered some of this. And if so, how much more decline do you see over the next 2 years? So I guess, we've kind of talked about that. Josh, you don't expect to see anything massive happen, no real crash in the stock market. But maybe you could talk about, are there things that you would recommend avoiding?
in terms of like a certain asset class, that type of thing?
Sure.
So, the last, 10 years, the FANG stocks have just been, red hot. Facebook, Apple, Amazon, Netflix, Google. So most people were pretty overweight technology in their portfolios. They've owned those very heavily. That they were the large drivers in the S&P 500. I'm not saying I wouldn't own tech, but it might be a time to, one of the things that we do in one of our investment strategies is we look at the sectors of the S&P 500 and we kind of own them proportionately to how we feel about the sector. So we've sort of been, moving more towards an underweight in tech. Like I mentioned before, we've, overweighted energy. So that I wouldn't say avoid, but possibly, I think it's a good time for people to kind of look at what's in their portfolio and have somebody, if you're looking for professional advice, have a professional look at it and say, we may trim here or add there, that type of thing. But I would say avoid highly speculative assets and buy quality would be a kind of an overarching theme.
Gotcha. And Danuska, one more, and we'll end it with this one, guys. But if you work offers for free financial planning services, is it different if you went seeing an independent financial planner?
So I'm not totally sure on that. What the question is, I would say, so we only charge a fee. We don't charge any commissions. The way we work is we charge a fee for assets under management, and all of the planning is included. We're a fiduciary, so we're working with the best interest of the client in mind. We don't sell any commission products. We don't sell life insurance or annuities or anything like that. So yeah, independents are good because they tend to not be selling a product. Not that, some of the bigger financial advisors with the bigger firms are, they're doing what's right for their clients as well. But we're an independent and work on a fee only basis.
Well, you've been a great guest.
Well, thank you. I appreciate you having me on.
Yeah, we definitely appreciate your time. And guys, what we try and do here at Sachs Realty is just bring you information, that you can, kind of decide, make educated decisions. We're all in this together, right? I mean, as I said in the beginning of the show, no one has a crystal ball. It's easy to Monday morning quarterback, but we're trying to at least provide value, get you some information, because we know, I mean, it's, we feel the pain. I mean, everyone right now, no matter how much money you have or don't have, things are going up, costs are going up. The system seems the whole financial world seems unweighted right now. And, we thought a lot of people, they thought they had a lot more money than they did, now with 2022. And we're trying to look forward to a strong 2023, make some great decisions. And we appreciate you watching tonight, guys. We wish you a very happy holiday season and a Merry Christmas. And guys, we will be back next year on our Tuesday night podcast. But don't forget, we still publish videos a couple times a week. So if you haven't already subscribed to our channel, do so now. Make sure you hit that alert bell. You'll know every time we upload content and go live, just like tonight. Josh, thanks a lot.
Thank you, Todd. Happy holidays.
All right, guys. Yep. Happy holidays. And until next time, have a great week.